Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, this is Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View. Today, I'm joined with Chris Marinac, who's with Janney Montgomery Scott, and he's a director of research. And so he's actually joining us at a very interesting time because he covers a lot of the regional banks and the community banks and the national banks too. But he has a pretty unique view, just given he's talking to a lot of the public banks, especially, and just given all the chaos that's been in the marketplace, dealing with higher for longer interest rates. And now you've got the Fed actually cutting rates. While they're cutting rates, short-term rates at least, you're starting to see, obviously, the 10-year actually went up. So, which to me is a little bit counterintuitive because historically 10-year would start to drop and long-term rates would start to come in as short-term rates are dropping as well. Chris, how is that impacting banks today?
So banks are seeing their cost of funds come down just a little bit with the Fed cut last week. I mean, we'll get the real data in October and obviously again as fourth quarter is announced. But Greg, I think what's happening is that the cost of funds came down the past year when the Fed dropped 100 bips last fall. And now you're seeing one more leg down with this 25 basis point cut. Typically banks are going to get maybe about a third of the rate cut. So if you cut 25 on Fed funds, you're going to get about 7.5 basis points, maybe 10 if you're lucky. That's kind of what you're going to see fall. So that'll help net interest margins. The question for companies is what are they doing on new asset yields? We have some banks who are resetting super low yields from 2020 and 21, and they're getting better yields and spreads because they're simply just having a mix shift. I think at your large bank level, they were resetting interest rates for the past year. So now this incremental rate cut is going to put pressure on new yields. And of course, competitive spirits are very high, and you're going to see banks be more aggressive on new loans they do. Banks, I think, are under pressure to put money to work. One of my themes right now, and I'm sure you're saying the same thing, Greg, is that liquidity is everywhere. And in fact, liquidity has actually stepped up another leg in the past 60 to 80 days, as far as I look at it. It could be related to crypto. It could just be good old-fashioned confidence has come back after a lot of chaos in April, May, and June. But there definitely has been an influx of liquidity the past, I would say, 10 weeks as we sit here in late September.
So how does that impact banks' willingness to lend for commercial real estate? Just there's been a trend coming out of the great financial crisis going back 15, 16 years ago to do less commercial real estate lending. The regional banks, it seemed like on average probably had 2 to 4 times the exposure the national banks did to commercial real estate loans. And, although the regional banks continue to have outsized exposure, the national banks definitely didn't jump back into commercial real estate lending at any really scalable level. But then it seems like the regional banks have been sort of limping along on their willingness to lend to real estate since 2022. What's your thoughts on that?
So 2 things were at play. Ever since the summer of 21, there was a regulatory clampdown, first on bank M&A, then on sort of the bank regulatory channel as it relates to CRE. There was just a heavy focus on trying to get the banks who had higher concentration to lower concentrations. So this was less of a problem for the Truists and others of their size. So Truist, PNC, people of that bigger regional bank. As you look at kind of more the mid-sized regional banks or Ameris and South States and United Community, they had to be careful, even though they weren't extremely concentrated, they had to be careful of how much they could do in real estate. So you had more push for C&I. You had a little bit of a thoughtfulness about the types of CRE they would do. We were still transitioning away from hotels at the time because of COVID. I think you had a push for industrial, then industrial became a little bit too hot, and it kind of moved its way through the various types. And office never was super popular, but office, of course, became a 4-letter word as 23 and 24 came into being. Answer to your question is that I think the concentration was the main issue. And then, of course, as interest rates went up in 22 and then 23, the debt service coverage ratios began to struggle. The math was working against the banks, and they had a lot of loans that they had to criticize where they were not necessarily below water in payments yet. They were simply saying debt service coverage struggle, and the regulators were also being persnickety about what they called cash flow. So this go around, the Fed, OCC, FDIC only wanted to see primary sources of cash flow count in the DSCR calculations. So that also was another sort of pain in the neck for banks that led them to be less willing to lend. As we fast forward now to late third quarter 25, interest rates have come down. Banks have dropped their concentrations. We have had this big influx of liquidity. We've had plenty of loans roll over, and the banks have to put money to work. The good thing is the banks are really well capitalized. They have the cash as well as capital to deploy, and they do want to grow earning assets. There is a penchant for banks to try to put new business on the books because they have to put spread income on the books, even though they will buy back stock and they will do other strategic things like PNC buying a bank here or there. And certainly you have some other marriages happening on that. But the basic fundamentals are the banks have to put their cash and capital to work. And so now that's where I think you're seeing some more nibbling. Plus, I think the problems that banks had were mostly solvable. And even with the office issues that have big write-offs, they largely have reserved for those. And now it's a question of punting those issues and taking the charge-offs. I feel like Q3 coming up on reporting in October, as well as in the year end, fourth quarter, you're going to see a lot of losses taken at banks just to get rid of those office loans that are on the books. Just think of your regional bank. They may only have 2 or 3 percentage points in office, but the problems they have, they're going to jettison those, both through sales, charge-offs, some restructurings, but a lot of it's going to get dealt with here pretty quickly, which I think is going to be healthy.
So you think there'll be a big push just to sell off exposure this year as you close up?
Absolutely. And if I think of a regional bank, they've already taken a reserve build for that office exposure. Now they're going to simply clean it out and get rid of it. The question is going to be, is there something new coming behind? That was the whole debate in last year about maturity walls. I think it was a little bit overdone in terms of the fear of maturity walls. They're still out there. The banks aren't completely out of the woods, but I think some of the near-term issues they've reserved, and they're going to now punt those. And I think the liquidity that's there at all the debt funds that you're well aware of is going to really start to get exercised in a bigger way because the banks want to go on to other business and not sit on problem loans.
Yeah. And so we'll jump to private credit because you mentioned debt funds. I got to use the word private credit, although debt funds have been around, private credit, private lenders have been around forever, but the media has glamorized private credit. So I got to give private credit today. But before we talk about that, just taking one step back, one thing we didn't talk about is just the transition from the Biden administration to the Trump administration. It seems like we had this transition where Biden was, and just in general, Democrats tend to have a more regulated environment. The Republican push is typically to be less regulated. I mean, are you seeing much differential in how bank regulators are interacting with banks? Is there easing that's truly taking place across these banks today?
The answer is yes. And I think it's more easing today in September and heading into the year end than there was 6 months ago. These things tend to take a couple of quarters to really gain momentum. That's what happened in 2017. You had a change in the White House. It was slow for a couple of months, and then it really caught hold in the second half of 17. The same thing's happening now. I think the regulators are easier on banks. They're creating more clarity, and it's sort of about trying to get business done. Now, the caveat I would say to you, Greg, is that I feel like the regulators still do their job. If a bank's engaged in a fraud, they're going to, dig into that. And we've got one of those in the banking system outside of real estate. It's in the auto lending business. And that, I'm sure, has already had some phones ringing in the past 2 weeks. I think in general, real estate, I think there's simply going to be a function of if you have a problem and it's reserved for, get rid of the problem. That goes back to my point about, I just use PNC because they've given really good disclosure about reserving for office, having the issues they think addressed. Now it's time to take the losses and move on. What I haven't seen enough in the real estate data coming from the FDIC is the actual charge-offs hitting. And I feel like that's what's going to change in the third and fourth quarter when you see the FDIC filings early November, and then again in early 26 when you see Q4 come through. That's the change that's going on that I think everybody should be anticipating.
Got it. And let's jump to private credit. You've seen private credit, you've seen private lenders take a bit, especially the last 3 years and really over the last 15 years, there's been this growth of private credit across all of lending side of commercial real estate, but even within commercial real estate, and has taken some market share. I mean, do you see, just as banks, to your point, banks are starting, obviously, their balance sheets are healthy. They're wanting to, obviously, lending tends to be a more profitable business in general. It does come with risk for them. I mean, do you see them just going direct to borrowers, or do you think they've gotten to a point where a lot of these banks are they see a better model just partnering with groups like a Peachtree on the private credit side? Or what's your take from that perspective?
I think you're going to see banks partner with your group and others more often. It feels, and I'm not sure if this is the banks being lazy or the banks have figured out that this is a better mousetrap for them. As you know, the customer wants to put more leverage on if they can. So if a bank is willing to offer 50% or 55% leverage and a private credit fund is willing to do 70 or 65, that's a material difference. And so if the bank can say, hey, we'll lend to the fund and we'll give them a line of credit, that is a better mousetrap for them and a better risk than trying to do the individual one-off borrower. And that's what a lot of banks are doing. What's interesting to me and what I've encouraged as a longtime analyst is the banks to talk more openly about what exactly they're doing, because I feel like the banks want the deposits from the borrower as well as from the fund. And we saw this in the venture capital world. And while Silicon Valley fouled it up in 2023, as we all remember, there is a way to do business with private funds where the private fund is not a depository. They're not offering deposit insurance. They want to put their money out and get paid a fee and get obviously make, issue $1 and get $1.20 back or $1.50 back over the long run with their capital. The bank can manage those funds. The bank can offer depository and treasury services to the end user. So there's a reason for a Synovus or now Pinnacle, for Webster Bank and Regions and other mid-sized regional banks to be players in this business. And I feel like that's where the action is. The line of credit that gets disclosed in the Fed and FDIC call report is called a non-depository financial institution loan, NDFI. Those loans have been exploding the last couple of years. Some of that is the banks have defined their reporting because of a regulatory rule change Q4 of last year. And so you have much better data available for sort of geeks like me looking at the quarterly information. But I feel like even if you take that sort of reporting requirement aside, banks are doing more in this channel. There are many banks who are doing this, and I think it's only going to continue. The question is, it's a balance. So if you have 15 to 18% of your loans in these NDFI loans, well, you go to 20 and 25. Goldman Sachs is at 50, but Goldman's is a huge company, and they have a lot of different things they're supporting, not just commercial real estate and not just sort of other C&I and business intermediaries. They'll do mortgage and they'll do some other true PE firms too to support other parts of their investment bank. So that maybe Goldman's not the best example, but I think your regional banks certainly, want to play more in this pond, and that seems to be where the overlap of banking is. The issues from a credit perspective have been near zero. It feels to me like that's going to change, and I think that overall is something that will continue to evolve as these next couple quarters play out. But it definitely is changing as we speak, and the banks are growing this channel for sure, and it's certainly the most popular source of loan growth for your top 50 banks, as I see it from a data perspective. So I know I gave you a lot there, but I think it's important.
No, that's hugely helpful. So just because we're coming to sort of the end of this, just a couple of very rapid fire questions and just quick thoughts on it. Extend pretend obviously has been big over the last 3 years dealing with this higher for longer interest rate environment. Everybody's been waiting for the Fed to cut rates. And at least obviously, as we talked about at the beginning, short-term rates started to drop. It sounded like from some of your comments earlier, you feel like, and I don't want to put words in your mouth, that extend and pretend will continue in the face of like the next 12 months. That wall of debt maturities that we keep talking about keeps expanding. Like it's roughly about $1 trillion of loans, which probably about half that, maybe a little under half that's on the, the balance sheets of banks. I mean, do you think they'll continue just to extend and pretend, or do you think that's going to lead to an avalanche of note sales, or what do you think will end up happening?
So I feel like the extending is yes. I think there's less pretending than people think. And maybe I'm just an analyst being supportive of the bank industry, but I feel like the banks are taking reserve increases. The banks have been increasing reserves. So what I could tell you is live examples of a Flagstar Bank, an Eagle Bank, a First Guarantee in Louisiana. Those are companies that have had above average commercial real estate problems. They are absolutely building reserves. They are taking charge offs. They're taking action. They're not done. They've got more work to do. I think in the case of Flagstar, they are probably still going to have a loss this quarter. They've articulated that, but they should turn slightly profitable in Q4. And that's all multifamily. And a lot of it is rent controlled in New York City. And even despite all of the issues in New York City with the mayor uncertainty and rent control restrictions, they've taken some losses, but not as ugly as people thought a year and a half ago. Same is true on the office side for an Eagle Bank and really a lot of other banks who have a handful of multifamily problems. They're addressing those with reserves and they're working through them. I think you're going to see more note sales. I think you'll see restructurings. I think the A and B note structure from the 90s is back at a lot of companies. The regulators like that answer. I do think that there's a whole host of mid-size and smaller community banks who I think there's a whole host of community banks who have just started to address a handful of issues, but their issues are not systemic and their issues are not large enough to take them down. I look at them as nuisances to where they are going to renew loans, but they're going to take losses. The examiners are all over these banks to do something. Now, we can debate whether they're taking enough loss and that maybe they've got 40% losses and they're only taking 15. I think that debate's going to be with us for a while. But honestly, we're seeing more banks who are being aggressive to build reserves, take losses, and then admit that they're going to take more of that in the next couple quarters. And the beauty of this is they have the capital. They have the earnings, so they can take care of it. They just have to do it. And I think that doing has happened a lot more, particularly at the banks with problem assets. So, a couple of the companies I referenced, they have their examiners all over them to address issues and not wait. So the question is for the one-off issues for everybody else, are they going to sit and are they going to pretend? There's always some of that, so I don't want to be too defensive, but I do think there's more action than I think people realize.
I've got two questions left, and these are going to be very quick questions. One is, bank consolidation. It's been happening over the last 40 years. You had 15,000 banks today. You have closer to 4,000. Do you think 5 years from now, what do you think the number of banks will exist? Will it be more or less?
Oh, I think it'll be less. I think you're going to see about 15% shrinkage. So if you look at all the charters in the FDIC, and this includes a ton of small community banks and family banks, it's like 4,450. So if we consolidate 600 to 700 charters, which would be, roughly 15, 16%, I think that's a good expectation for the next 3 or 4 years. And some of that is going to happen anyways. The question is, will you see big transactions that matter? So certainly Pinnacle and Synovus was a surprise that wasn't on anybody's dance card. It does make sense. I think it can be very effective. It will lead to change, whether you like it or not. Not everybody will be happy and people will move. And I think the banks are probably going to see 1+1 from an exposure standpoint, ultimately go backwards just a little bit. Not every borrower is going to be able to borrow $100 million. They may have to borrow 80 to where they get a 20% cutback, and they'll find the other 20 at another who'll be willing to work with them. I think that will change at that merger. But the question is, will you see other regional banks? What happens to Comerica? What happens to Key? Both of those have pressure on their companies to do something. And they certainly can survive. They have plenty of capital. The question is, what makes sense for their shareholders, and are they better off to find a partnership? And I think there's probably 10 other examples of that size that, are going to play themselves out. And I think you get 1 or 2 that happen in the next year, 18 months, and then the next sort of 3 to 5 will happen after that. But I do think you're going to see consolidation. And what's fun is it's going to create opportunities for private capital. It's going to create opportunities for other community banks. It's going to move sort of the deck chairs around for activity, which ultimately I think is good for everyone who's looking for an incremental business idea within the lending community, whether it's regulated or not.
So, and then the final question, because these, as we put these together, we do this podcast, there's usually a delay by a couple of weeks. So when this airs, people are going to probably sort of chuckle one way or the other. Since we're both in Atlanta, right? And there's a big game on Saturday. It's Alabama, Georgia. Who do you think is going to win the game?
All right, so I'll take Alabama with the upset.
All right. I agree with you, actually. So like, I'm a huge Alabama fan, so I will take that as well. So to close this out, I mean, the one thing that gets me excited from what you're saying, Chris, and what I'm hearing is that the banking system itself is relatively in a really good place. But more importantly, there's still going to be a lot of opportunities for groups like us and for investors to take advantage of just what's happening in the marketplace. Banks are still going to have to unload, some assets that are under stress or in distress. So, I mean, if you're an investor that invests in commercial real estate, there's going to be opportunities there. I mean, there's going to be consolidation in banking. There's going to be huge opportunities there as well. Just as banks merge, they tend to sometimes sell off portfolios, which, provides, opportunities for private lenders. It provides opportunities for just traditional investors. And there's going to be the need for private credit. It's only going to probably grow because banks have really appreciated the fact that they can unload a lot of the risk to private lenders and still benefit from the standpoint of still getting capital or still lending money in a more protected position, and also getting the benefit of deposits and things like that, because private lenders usually don't carry deposits. It's a very symbiotic, beneficial relationship between private credit and banks. But with that said, really appreciate you joining today. And if you have anyone listening has any questions, feel free to reach out to myself or Chris. And really appreciate y'all joining today and listening to another episode of Peachtree Point of View. So thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.